What's the most important resource that you have? If you really thought about this deeply, I think you'd come to the same conclusion that Joey and I did. It's time. In our newest book, What's Without Wall Street, the 3 Steps to Financial Freedom Through Passive Income, we talk about how are we tracking that time? What is the thing that we can do to get more of that time back?
That's right. If you've ever been listening to our podcast and thought, man, it would be amazing if I could take all the things that you guys have learned over the last 10 years and just summarize them, put them in some way to easily digest them and take action, that's what this book is all about. You're not going to want to miss it. Go to wealthwithoutwallstreet.com/new book and get your copy today. Wealth Without Wall Street Tribe, I hope you're ready to take notes with our good friend, Robert Hytha. Robert, so glad to have you in the show today.
Hey guys, how's it going, Joey? Russ?
Robert, yeah, we're pumped to start learning about notes. This is something that we've kind of dipped our toe into up to this point, but looking to expand our knowledge base. So tell us, man, why should we be even interested in learning about notes? What has it done for you, and what could it do for me?
Yeah, for sure. Well, notes is next level real estate. You move up the real estate food chain when you buy a note, you become the bank. And we love that position in the real estate capital stack. We're at the bottom of the capital stack. We get paid before anybody else makes a profit. We're the top of the real estate food chain. So notes are just such a powerful investment strategy to get into. The 3 main reasons I really like notes, and the first one I think maybe a bit counterintuitive, just because when you think of being the bank and owning a mortgage note, especially what I do with non-performing notes, you often think foreclosure, taking properties, really disrupting a community in a sense when you have to foreclose on a deal like that. But I actually think that it's the opposite, and there's a big humanitarian angle of note investing that is kind of overlooked. As an investor, as an entrepreneur, we're able to help borrowers where the banks have failed. We're able to buy non-performers, come up with out-of-the-box creative solutions to get them back on track. And as opposed to like amassing this portfolio of residential real estate rental properties, where you're essentially competing with homeowners, that's really disrupting a community. With note investing, you want to keep your homeowners in their homes. All you're looking for is a monthly mortgage payment or potentially a refi payout, or if the homeowner can't afford the property, help them sell it and get you paid off. So I really think humanitarian angle here, to build a big portfolio of mortgage notes makes way more sense for the communities you're investing in than buying a bunch of rental properties. Now, there's one downside, I will say, when a mortgage note pays off, you have to redeploy that capital. With a rental property, you can hold that forever. You can get those lease payments into perpetuity. But with mortgage notes, there is that life cycle. You do need to redeploy your capital as you go.
So it can't be all roses, right? You got to have it every once in a while. Like, man, what do I do with all this money now? It's so hard.
Yeah, for sure. Payoffs.
I love that. So tell us about, how did you get into this space? Like, what was it that drew you? I mean, obviously you told us what the good things are about it, but
well, I only told you one good thing. There's 2 others to mention, and then I can share how I jumped in. The next one was cash flow without real estate management. So property management. If you're a property manager, you know the struggles of plumbing disasters in the middle of the night, and I've had my fair share of them with my rental portfolio as well. Which, by the way, diversification. Don't only buy notes. Don't only buy rental properties. Having both is awesome. The rental properties appreciate as the mortgage notes get paid down. So that cash flow is huge because it's a mortgage payment, not a rent check. There's so many less strings attached to a monthly mortgage payment than a rent check. You're never calling your bank up to fix your toilet or to handle those late night plumbing issues. So the third one then is just huge returns. This is a niche industry. So we're able to use that knowledge and expertise that we develop in the mortgage note side of the business to get deals done that other people don't even realize exist. Becoming the bank, working with non-performing homeowners to get them cash flowing again. It's just a huge opportunity there. So yeah, sorry to jump back to that. But as far as how I got started, I came up in a real estate family. My parents were buying and fixing and holding rental properties in a small town in Pennsylvania from when I was born up until today. They're still in the game as entrepreneurs. So I knew first that I was going to be an entrepreneur, and second, most likely would be in real estate. And in 2011, I was a junior in college, and I had a guest speaker come into an entrepreneurial business course to talk about a business that they had started in the secondary mortgage market. And at first it was like kind of esoteric, like what are these guys even talking about? But as I began to understand all of those advantages that you have as a note investor, I saw this kind of path for me that made way more sense than the path my father had taken and my mom had helped him with, which was way more hands-on, way more, getting your hands dirty, and really not the skill set that I had developed using the computer and talking on the phone. So note investing allowed me to get into the real estate game, but with a laptop and a cell phone, and not necessarily having to manage my GC and, buy materials and do all the things that my father was doing, which at the end of the day is an awesome business. But I think in any strategy that you approach, you need to understand where to pivot, where to look for opportunity. And this is an opportunity that a lot of people don't even realize exists. And that's what gives us a lot of a advantage.
So I can't wait for you to break down the deal that you said nobody even knew existed. So I'm waiting for that. Russ, can we get to that at some point?
Well, I think that's what we need to do. I'm interested. I want to know more. Tell me, how do I figure this out? So what would you say are those key pieces I need to understand in the note investing space?
Sure. So three general areas where you need to really get comfortable with. First is sourcing and acquisitions. And that's number one, because it's the most important, finding deal flow. And as we mentioned, deal flow that nobody even knows exists. There is a thriving secondary market where market makers, other intermediaries help banks sell non-performing loans to investors and hedge funds. But really, the sweet spot is when you're going to be developing your own sources. So talking to local banks and credit unions, to their loss mitigation departments, their portfolio managers, and essentially giving them an exit strategy for their non-performing paper. Just to understand the high level, deal flow of this business, a loan originates and the borrowers don't intend to stop paying, but eventually some of these homeowners do hit a default event that causes them to not be able to afford their monthly payment, and the bank charges off the loan, which is essentially an internal accounting process where they're able to take a write-off on the amount that they loaned on that account, and essentially saying, like, we're not going to pursue this account anymore. We're throwing up our hands. There's no more resources to allocate to these charged off loans. A year or so goes by, and those charged off loans are then resold because there's still liens secured to the properties. There's still promissory notes that the homeowners owe, but the bank has just decided that they're too resource intensive. They're not going to pursue foreclosures. They can't handle the REO process, real estate owned across the country. They end up just selling those loans for pennies on the dollar to investors in the marketplace. So to be able to source those opportunities from local banks, credit unions, you'd be surprised how many small banks have loans in their portfolio that they need solutions for. And you can provide those solutions as a note investor. And not necessarily as an investor who's putting loans into your own portfolio, but actually as a market maker, as a matchmaker. So we don't call it a broker. A broker is essentially SEC registered, like you need licenses to be a broker. But to be a mortgage note matchmaker, to connect buyers and sellers together and earn transaction fees, is a great way to get into this business without any of your own capital. It's about relationships and about understanding just enough about this next step, which is due diligence and analysis. So that's the second phase.
Yeah. Before we jump there, because I'm sitting here thinking through this one, the thing that comes to my mind is how many houses are out there where somebody's living in it and they're not paying anything and the bank isn't even pursuing them? Like, is that like a really small number? Is that fairly large?
Yeah, you'd be surprised. It's FDIC data. All of these banks are insured by the FDIC. So they do a quarterly report of all of the non-accrual and charge-off loans in their portfolios. So non-accrual means that there's no longer interest being accrued, and charge-off means that they've taken that accounting write-off. And there's a surprisingly large number. You can use tools like Distressed Pro's Bank Prospector to essentially visualize that FDIC data. But it is public record. You can look up the FDIC quarterly reports and get the information about all the banks in the country that have these loans on their books. And you can also do sort of a reverse inquiry into your own neighborhood by looking at the county records to see that if some of the loans have been assigned. So assignments of mortgage are when deals are transferred from one party to another. You can see them in the public records to see that there are deals happening. And you can also look for lis pendens, which are the beginning of the foreclosure process, to see if loans are being foreclosed upon in your marketplace. But at the end of the day, actually communicating with these credit unions, the banks, and the decision makers within them, doing that prospecting effort is going to be the best way to actually get that deal flow to bring it to market.
And I'm sorry to go deep here, but this is like interesting to me. Like, at what point in time does the bank, you said that there's certain deals that they're going to charge off because it's not worth their time or they don't have the resources to go pursue foreclosure. Like, what does a typical deal look like that where it's, I mean, in my head, I'm thinking it's a broken down trailer that they lent $15,000 on. And they're like, we're going to spend way more time just trying to move this thing than what is an example of something like that? Because I have no idea.
Yeah, good question. So at the high end, the most likely place is going to be successor by mergers. So when a bank acquires another bank, they take on all of the failed bank's assets at pennies on the dollar, even less than we would be buying it for as a note investor buying a non-performing asset. So those loans that they're buying as non-performers from the get-go, they basically have a zero value. So selling those loans is low-hanging fruit. They're going to make a profit selling them, even if they're selling them for 30, 40 cents on the dollar. So that's the number one. If a different bank had already kind of done that charge off and a new bank is acquiring them. As far as deal flow with the banks that have not been transferred through that successor by merger process, you'll see that just as an SBM on assignments of mortgage and in public records. But essentially the standard deals, it's really interesting because these charge-offs happen normally 2 years or 3 years from the time in the future when the loan is sold. So a lot of times the deal might look pretty hairy when it was charged off, where there's negative equity, the borrower's not paying their property taxes or any of their mortgages. And then 3 years later, the default event has passed. So sometimes if we're buying a second position mortgage, which we love second liens, the first lien was previously not performing and they weren't paying the taxes through the escrow accounts. Now the borrower's back on track on their first mortgage. You can check the property records and see that the taxes are being paid. That second lien, though, is still hanging out unpaid, still in default. So that type of situation where the property is worth $500,000, the first mortgage is $350,000 and the second mortgage is $100,000, you've got positive equity. It wasn't positive equity 3 years ago based on the property values and some other, the higher balance of the first. But now 3 years later, it's a lot more viable of a situation. So that's kind of an interesting timing component where things change. Equity increases. Other liens get paid down. People get back on track. The default event might have been a loss of income. It could have been a health event, any number of things that then 3 years later, they're beyond that and they need help just putting the pieces back together.
That's super, super interesting that the bank could have already written that loan off and now it's back on track. And so how do you uncover things like that? You said sourcing, right? So there's the first step is always to look for deals, but then how do I know that it's a good deal? Like you just mentioned some things that I would have never known to even look for. What's that? How does that play into this whole concept?
Yeah, so super important. You make your money when you buy in real estate. So understanding that waterfall due diligence process is critical. And we call it a waterfall because as you go down the waterfall, some of those droplets are splashing off. If you think of the water in that waterfall as assets, and you don't want to go all the way to the bottom of the waterfall and spend all the time and money doing your research on an asset if in the beginning of the process you identify something like an unsecured status. So I'll use that as an example of due diligence. We don't have to get too in the weeds, but secured versus unsecured is the biggest driver of price in the secondary market. And secured means you can foreclose. Secured means that there are, the collateral behind the loan can be used as leverage. You can go through the foreclosure process to take back the deed if the borrower does not get back on track with the loan. Unsecured means that there is no collateral, like credit card debt, for example, is unsecured debt. And a mortgage can become unsecured through a couple of different processes. One is going to be if a senior mortgage forecloses and you are in second or third or a junior lien to the first mortgage. If the first mortgage forecloses and the value of the property is less than the other liens on that house, then you're left with a collectible promissory note, but no mortgage securing that to the property any longer. The way we check that is pretty simple. When you do an analysis on a mortgage loan, you'll have a spreadsheet, which we call the data tape. And the spreadsheet has the borrower's name and the property address on it. If you search that property address in the county record, you can see who owns the property because all the deeds are recorded and those homeowners are then in the public record for anyone to see. And if that homeowner doesn't match the name on your your data tape, the spreadsheet, which has the borrower's name on it. If there's a mismatch there, the borrower no longer owns the home, which more than likely it's unsecured. Now, there are false positives and false negatives there, which is a little bit more in the weeds, but the high level is if the homeowner that you think your borrower no longer owns the home, then it is unsecured and you cannot pursue the foreclosure. And that loan is now worth less than 1% of the principal balance. Unsecured debt, at least in today's market, trades for like 50 basis points. That's half of 1%. Whereas a secured loan that still has that foreclosure leverage built in is worth 50, 60, 70 cents on the dollar, even as a non-performing asset. So that's the first thing. You need to make sure it's secured. And then from there, it's property value and equity. If it's owner occupied, it's more valuable. If the borrower is paying their property taxes, of course, more valuable, more equity, but also the borrower's intentions. When we see an owner occupied loan where the homeowner is making payments towards either the first mortgage when we're looking at a second, or the property taxes when we're looking at a first, then we can be pretty certain that that borrower is also going to pay our lien at some point, because they're already making it clear their intentions are to stay in the home and make those payments towards their other obligations.
Trav, you're getting a 301 breakdown on how to invest in notes right here. So take some.
I can't help but get into the weeds. Sorry.
No, it's good. Like that's what people want, right? Like we want a high level, right? Like, why is this important? Why should I be interested in this? But as we dig into that, we need to know like what's involved, right? When people go through our investor DNA process, one of the questions we have at the end is what's the key factors, right? If I'm going to be an active investor in this, like actively involved, what's the level of detail that I need to have in order to be able to make it? What you're doing is high level, right? It requires a decent amount of detail, but clearly there's gold. You just have to sift through it to get there. Now let's talk about the third point. How do I make money in this deal?
Yeah, great. So with non-performing loans, that's the name of the game, is getting the borrower back on track. So when you actually negotiate a deal to close it, you've already done your due diligence, you've settled on a price with the seller, and you're ready to buy it, you sign your contract, you could send your funds to an escrow account, and won't get into that. But frankly, I've used escrow when I've sold loans 1% to 2% of the time over the last 11 years. Most buyers, once you build a relationship with them, they wire funds to your account, you send the collateral file to them, and then you do the servicing transfer to their loan servicer. It's not like property closings where there's a settlement with title and an attorney and a bunch of parties involved. These deals happen on the phone and email, and you can get them done very quickly. So you're at the point now where you own the loan. You've got your servicing transfer, which means the loan servicer that was currently servicing the loan, not the lender, but basically the administrator of the file, sending the monthly statements, collecting the payments, making sure that everything is documented on that account. That's the loan servicer. And that's a third party that you will hire as an investor. So it's been transferred from the seller's servicer to your servicer. A RESPA letter has been sent, which is the Real Estate Settlements and Procedures Act. It's just the letter, we call it the hello letter. The previous servicer sends a goodbye letter. The new servicer sends a hello letter. You've received these before if you've ever borrowed money on a property, because the secondary market, even for performing loans that have just been newly originated, it's very, very active. So very shortly after you originate a loan on your own home, you probably got a RESPA letter with servicing transferring from one party to another. So that's the next step. Now your loan servicer has the account and they can start the process of getting payments received. But most of the time with a non-performing homeowner, they're not going to get that RESPA letter and call you up immediately. It does happen actually more often than you think, where they get the letter and they're like, I was waiting for someone to let me know what happened to this loan that was charged off and I haven't gotten a statement on it for 2 years. They get the RESPA letter, they reach out to the loan servicer, and you can get back on track that way. But we'll go through the full process to show you maybe a more realistic version of this whole process. So next is the outreach to the homeowner. So as you know, they've not been paying their loan. Your loan servicer wants to get payments started again. You want to get payments started again. So the next step is to send a letter, normally called a welcome package, to the homeowner, introducing yourself as the lender. Because again, there's two parties here, the lender and the loan servicer. And we'll introduce a third party in a minute here. But the loan servicer is not able to negotiate with the homeowner unless you give them a bunch of delegated authority. So really that comes down to you as the lender to agree to some type of modification agreement if the borrower wants to start making monthly payments, to agree to a short sale maybe if the borrower needs to sell the property and they owe more than the home is worth. Connecting them with a realtor, for example, or another exit is a deed in lieu of foreclosure. If the borrower can't afford the property anymore, and as opposed to a short sale, which could take a little bit more time, they want to deed the property back to you as the lender, you can send them a deed in lieu of foreclosure to avoid foreclosure on their record, but to accept the deed in exchange of clearing the debt. So it's a really great way to acquire properties for pennies on the dollar through the back door here, buying the note and then negotiating with the homeowner to take the deed. Another exit strategy. And then you can run your regular playbook on rentals or fix and flips or whatever you do with REO.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before, go to what'swhatwallstreet.com/PIOS. There was nothing worse than walking into class when you're in school and the teacher saying, pop quiz day. Why? Because you were unprepared. Are you unprepared though for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
Tribe, I know you are thinking just like Russ right now. The only thing that Robert just said that you're excited about is working the deal, right? Negotiating 50 cents on the dollar on the front end and then turning around and getting somebody to start paying you on the back end. Russ is sitting over here. He's just like chomping at the bit. Who can I call? Who can I get on the phone? And can I make this deal happen? Now, the rest of us, including me, they're like, I'm not doing any of that, right? I want to be passive as I can possibly be. I want to put money into the deal, but I don't want to be sending a hello, goodbye, or how you doing letter. I don't want to be on the phone with a bank trying to negotiate the deal. I don't want to even get on the phone and try to work it out with the homeowner, because I don't want the sob stories. I'm just gonna be honest with you. I'm a high S personality. I start getting all emotional. It's just not good. So talk to me about the guy that says, that's not for me, but maybe there's another way to get involved with notes. And by the way, Tribe, go to wealthwithoutwallstreet.com/FIXnotes to get all of this information. Like Robert's given us the behind the scenes. You now have access to like a free course and other things we're going to get to in a minute. But how do I get involved, Robert? Because I'm just sitting here. Russ has already been on the phone with somebody. I'm just like, how do I get involved?
Yeah, and I see your t-shirt, that passive income. So I do want to mention that there is some ability to delegate as a non-performing loan investor. The third party I was going to introduce is your attorney. And if the borrower hasn't responded to any of the soft collection letters or anything you've sent, you have your attorney send a letter to the homeowner, often the demand letter, which will say, hey, we need to get it back on track here or else foreclosure is a possibility. And that process could be pretty hands-off. The attorney sends a letter, borrower reaches out to the attorney connects them with the loan servicer. If you set up your systems right and you have a good team, you could, and by the way, the team can be outsourced, having these different vendors. That can be somewhat hands-off, but at the end of the day, you're still doing due diligence on non-performing loans. There's still that element of risk. You're not buying cash flowing assets. So that's really where the spectrum of active to passive goes to the next step, and that's buying cash flowing loans. Buying a performing loan that's already cash flowing is really just a matter of transferring the loan servicing and then making sure your loan servicer gets the payment every month. So you can audit the portfolio once a month just to make sure the last monthly payment has come in. And the returns for cash flowing loans, 14 to 18% or so. And there's a range there. And by the way, actually a little bit lower for like high value, pristine first position mortgage, maybe 8 to 12% if you go that direction. We really like second liens because the returns are higher and they're just as safe as first when you do your due diligence correctly. So essentially earning around 15% returns is pretty fair for a cash flowing loan. Now, those deals are often sold by note investors who buy non-performing. They get them modified and then they hold them for a couple of months, which we call the seasoning process, and then they sell them, often to self-directed IRAs or other passive cash flow investors who just want to collect the monthly check every month. So that's a really good way to get in passively, but it's not diversified. You could buy 10 small balance loans or one big loan, but at the end of the day, that sort of defeats the purpose of being passive if you have to just buy a bunch of these assets. So the other next step of that spectrum from active to passive is investing in a note fund. So there are operators who buy non-performing, they get them cash flowing, and then they either hold those cash flowing loans or they flip them. That's the fix and flip in our business. It's so easy. It's just a PDF contract, talking on the phone and sending emails, and you flipped a non-performer you created a performer out of and sold. So those note funds essentially diversify your investment across a whole portfolio. So there's a number of these note funds. They're part of our mastermind group, and you can find some others online. But at the end of the day, that's going to be for more like 10% returns. So you're paying, you're earning a less return, but you're a little bit safer because you're diversified working with a professional operator. So that's sort of where you want to gauge your opportunity costs and what other opportunities you may have, but diversification, of course.
No, that's super good. I like the fact that you broke down the different ways that I can invest in that. Can you walk me through a deal? Like make it visual for me, right? I'm running on the treadmill right now. I've listened this long and I'm trying to figure out okay, what does this look like? Take me through a scenario, a specific one that you've done in the past. I think that may make all of this come together. Like if you could tell us how you found it, how did you do the due diligence on it? How did you monetize it? What's been the result? What's the net in your pocket? That'd be super helpful.
Yeah, sure. I'll kind of give you a generic but pretty standard situation to start. I really like seconds, but I know it can seem a little bit more confusing. So we'll just consider this a first mortgage. So let's say pretty modest $100,000 value property. The mortgage is actually, let's say that the property is $150,000 and the mortgage is $100,000. It's non-performing. It is owner occupied. The homeowner's living there, and you've checked the property taxes, and the borrower's paying their property taxes. So they want to stay in the home. And by the way, even if this home was only worth $100,000 and they owed $100,000, so technically it's nearly underwater, there's still this element of emotional equity in this business where owner-occupied residents are going to get their debts paid. They're going to get back on track, even when the numbers on paper don't necessarily make sense, because this is their neighborhood, their community, where their kids go to school. This is their home. So that's an important element here. Equity isn't always the end-all be-all as to whether a deal is going to get done or not. So in any case, the loan unpaid principal balance is $100,000, and the borrower, you buy the loan, you get it onboarded, you send your RESPA letter, no response from the homeowner. They either didn't get the messages, their head's in the sand, whatever reason, they haven't responded yet. So at this point, you can go one of two directions. There's a service across the country you can use called door knocking, where you can have a third party go to the door with a package from you, and sometimes even a warm transfer of a cell phone so that you can talk to that homeowner just to track them down. Because you've already done your skip tracing. You've already exhausted all your efforts to try to get a hold of this person.
What does that mean? A warm transfer of cell phone? Like the person knocking on the door hands them the phone so they can talk to you?
Exactly. Yeah, so that they say, hey, I'm with your lender. Here's some information, a welcome package about them. We want to help you get back on track. If you're available, I can get them on the phone in a second. And then they actually just give the phone and you get an email address and you start that conversation, start building rapport. Now that's one way, but I think most of the time, most investors are just going to go to the demand letter, have a local attorney who's licensed for lender collections in that state, send a demand letter to the homeowner and get them back on track. So in this scenario, let's say that the homeowner gets the demand letter and they're like, hey, this is our home. We don't want to lose it. We may be struggling financially here, but we at least want to start the conversation, because that's what that letter will communicate. At the end of the day, the best thing you can do is communicate with your lender to let them know where you're at so we can figure out some solution. So they reach out. They're not able to pay their regular monthly mortgage payment again, but you're able to get a loan modification negotiated with them. So that $100,000 loan, I guess we didn't say the purchase price. We bought it for $50,000. So we bought it for 50 cents on the dollar here. And at this point now, we need to negotiate a modification agreement that hits our number, gives us a yield that we're satisfied with, but also is affordable to the homeowner. Because really the worst case scenario here is that you negotiate something and the homeowner's like, yeah, I want to save my home, I'll pay this. And then they can't, and they just redefault, because that's good for nobody. So at this point, we're going to ask them if first for their own opinion on how much they can afford on a monthly payment. And maybe that fits our numbers. So for a $100,000 loan, I would probably be ballparking around $1,000 a month. I'd like to see about 1% of the principal balance in a monthly payment, because really, really rough numbers here, that's like 12% return. But you bought it for 50 grand, so it's a 24% return for you. But essentially, if you were to flip that loan, we talked about 10 to 15% returns for performing loans. You got a cash flowing at $1,000. You could sell it for close to par value for 100 grand and essentially be doubling your money on the fix and flip. But holding it for 24% return isn't bad either. And by the way, this is really kind of low end expectation, because we're not talking about a down payment. If a borrower has been in default for several years, expecting to get caught up with some type of down payment is reasonable. So that's really where we're going to start with this negotiation. Any down payment, we're going to apply directly to the principal balance, and then we'll get the monthly payment started in the subsequent month. So you can talk two terms there. What can they afford for a down payment? What can they afford on a monthly basis? So at this point, if they're good to go with numbers that fit your return expectations and they fit their finances, then get the modification agreement in place. You can use a pretty simple template. You put in the borrower's information, you get that over to them to sign. Your loan servicer will have an automatic payment method that they can just get the ACH payment set up. And then you're off to the races, collecting that monthly payment every month. But what happens if they can't afford the numbers that will pencil for you on your investment? A couple different directions to go. One is an interest-only loan modification. If you want to get them started on a cash flowing loan, but they can't afford the monthly payment that you'd expect, a short-term interest-only mod is going to be the lowest monthly payment amount that you can offer. Now, it won't pencil real well as your return on investment in the early days because they're only paying interest. But when you look at your internal rate of return, say that's a 3-year term. We normally do a step rate, by the way, like 7% year one, 8%, then 9%. So every subsequent year, they have more of an incentive to get it paid off. There's no prepayment penalties. Our interests are aligned. We want them to refi the loan or otherwise go into a longer term mod in the future. So at the end of that 3-year term, your internal rate of return with that payoff, the balloon payment, is going to be much, much stronger than if you did not start that cash flow in the first place. So that's another tool in your toolbox. Now, let's say they can't afford that either. Then what are you going to do? So the next step is to serve as somewhat of a financial advisor. You're not a fiduciary or anything, but you are going to assist them with figuring out where in their finances can they find a couple more $100 to meet that $1,000 a month you're looking for. Or sometimes, $100,000 loan is actually kind of on the larger side of the loans we see. On average, we're seeing more like $50,000, $60,000 loans. So they may only need $400 or $500 to start their monthly payment. So looking through their finances, their pay stubs, their tax returns, their credit card bills, to help them understand where they can move things around, where maybe there's, some misjudgments around like eating out or something. You're essentially helping them prioritize their finances because their home mortgage is more important than going out to eat. So understanding where they're overextending themselves and giving them some helpful guidance. And sorry, I'll let you ask a question here, and then I'll go to the very worst case scenario.
Well, okay. I don't think we can handle the worst case scenario, Robert, because at this point, either you heard Robert sharing with you exactly how to turn an asset that you can buy for 50 cents on the dollar and then double your money later. Like, that's a ridiculous return. And so you let off saying some of the things that you love about this. And one of those was the ridiculous returns. You just kind of showed us how that's possible. Now, if you want to get into the nitty gritty of actually how to become exactly what Robert's saying, and maybe it's not being the actual investor and building a portfolio, maybe there's something else for you. I want to encourage you to reach out to Robert through our specific link, wealthwithoutwallstreet.com/FIXnotes. That's FIXnotes. And Robert, what are the things that they can expect to get access to at that link?
I did want to just mention one quick caveat here, and I didn't realize the time has just flown. The scenario that I'm giving you with 50 cents on the dollar, that I would expect to be a second position loan, still with full equity coverage. A first lien with those same parameters, the $100,000 property value. I just use first lien, but now I feel like it's overly confusing. That first lien probably would have been 65, maybe 70 cents. So that particular deal, first lien, $100,000 home, $50,000 acquisition, probably would have been more like a $60,000, $65,000, $70,000 acquisition. So not quite double, but in a second lien, you would have certainly doubled your money on that deal. So just wanted to make sure that was clear. And then next, yes, what you can expect to find on the FIXnotes website at wealthwithoutwallstreet.com/FIXnotes. First off, our free course. We give you the comprehensive overview of this industry, which I think is really important because you don't necessarily have to be a note investor buying assets for your own portfolio. There are a number of opportunities to add value in this business. If you already have an experience and a background in real estate, you can apply that knowledge to this niche that add value to others that are investing in the space as a service provider. So this course will give you the overall picture of the industry, the life cycle of a note, so you can understand where you could fit in with your unique set of skills. I think that's really important to mention. And then once you go through the free course, participating in our free community. We have a forum where you can start to ask questions, to share where you're at in your note investing journey, meet others, maybe find partners or mentors. So participating in our free discussion boards, I think is just so valuable. I love the idea of your surface area for luck, and having serendipitous opportunities present themselves to you can only happen if you're presenting yourself, if you're putting yourself out there, and participating in a discussion board like that, your name is out there so that maybe people can reach out to you. And then the third step is just some hands-on activities to help you get started. On our YouTube channel, we've got a ton of case studies where you can kind of go through the steps. Some of our old episodes of our live show had, maybe I'll comment on your YouTube link with some resources, but essentially downloading spreadsheets so you can follow along and do some of your own due diligence as a practice. So I think taking action is just so critical. You can learn and watch videos and read, but until you actually do it, that's when the knowledge crystallizes, at least for me.
No doubt. If you try to do this alone without the proper education, I'm just going to tell you, you're going to fail. So I'm grateful for these resources. Robert, thank you for being on the show. If you guys found value in today's show, please stop what you're doing. Share this with somebody else who is also on the path to financial freedom. You can even take a screenshot of this and share it on social. Tag us so we know this is the kind of stuff that you're looking for, and we can help you get to financial freedom as fast as possible. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.